Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a tutorial that is on non-recurring items in the financial statement. So let's get into the details. See, the financial statements, they are sort of, a report of the performance of the company. They form basically a backbone upon which the business acumen is based. So for the outside world, the statements are window through which one can interpret the health and the wealth of the company. Okay, so let's look at the income statement of Colgate. And in the year 2015, there is a charge of Venezuela accounting charge. Let me show you that first. As you can see, this is Colgate's company. There's a charge of Venezuela's accounting charge over here 1084. So if you notice that the item that has been highlighted over here, we see that the operating profit decreases significantly, right? And due to the presence, get the things clear. If you see, the operating profit basically over here is decreasing significantly due to the presence of the item, and also this item is not present in the other years like in 2014 and 2013. So this item is nothing but non-recurring item. You can see over here there's nothing mentioned, and it can have some serious implication on the financial analyst also. So let's get into the nitty-gritty of the same. What are not non-recurring items? Let's learn first. Now, non-recurring items. We are going to learn why, when, how, and where. And what are the things that have included? It is we have things like restructuring cost, write-offs, write-downs, compensation for exploitation, losses from the lawsuits, plans, shutdown, act of God. So such are basically non-recurring in nature. There's a gain loss from early retirement of debt. There's a changes in inventory depreciation methodology, gain loss due to discontinued operation. All of this is nothing but some of the very important data regarding the non-recurring items. See, investors use extensive the statements in order to decide whether to invest in a firm or not. Hence, there has to be a transparent disclosure of the revenue and expenses from the firm's end, and to ensure that correct information flows to the outside world. But in reality, this does not happen. Most firms report their income and expenses as per the GAAP, that is, the generally accepted accounting principle, which is sometimes difficult to interpret for the analyst. Like, for example, a company purchases a land, a GAAP asks, that is the GAAP, asks the company to report the difference between the market price and the purchase price. So, of land as an intangible asset, and then it also asks the firm to report the amortization for the intangible assets over a period of time. So such entries are conditional in nature and are related to the occurrence of the event or purchase of the property. Further, such entries gave rise to non-operating revenues and non-operating expenses, as these are not tied up with the core business functions of the firm. See, GAAP basically asks the firm to report a consolidated number, single consolidated number, which causes these items to get hidden within the figures, and thus that is leading to the distortion in the valuations. I'll give you some examples of the non-recurring items. Like, here are some of the cases where non-recurring items have affected profit favorably or unfavorably. The companies referred in the examples are basically hypothetical. Let's take the first example as XYZ Bank. Over here, the bank reported a drop. Let's say this is the first example. Bank reported a drop of, let's say, 65% in the net profit for the September 2015 quarter as a result of the higher provisioning done to cover the pension gratuity as a result of the higher NPA. There is another example. Let's take ABC Pharma. These are all hypothetical examples that I'm taking for you. The company reported a net loss, let's say, of 100 or let's say 1000 million. So for the March 2014 quarter, though its revenue actually grew close enough to about 30%, the loss was basically attributable to the impairment loss which company took on the goodwill and the other intangible assets of its South African arm. So let's discuss some of the types of the non-recurring items. Now, there are primarily four types of non-recurring items. First is your unusual. It is unusual or infrequent items. Second are extraordinary or infrequent items, or again it is known as unusual. The third is discontinued operations, and the last one, that is third, and the fourth one is changes in accounting principle. So that is the last one, that is a change in the accounting principle. We'll discuss each and every in detail. The first one, unusual item. See, in the first type of the non-recurring item is infrequent or unusual item. See, this items are either unusual or infrequent, but not both. These items are reported pre-tax. We'll write for you as pre-tax, and whereas the other three types over here that I mentioned are reported post-tax, right? So now if you see some of the example of unusual, write-offs, write-down of inventory or receivables, gain or loss on the sale of assets, subsidiaries, affiliates, loss incurred on the plant shutdown, and so on and so forth. The next is extraordinary item, which is also known as infrequent and unusual. This second type of non-recurring item is basically extraordinary item. Extraordinary items are both infrequent and they are unusual. This is very important. Both the things, and are reported at the net income or net of the income tax. Some of the examples, I'll take 2 or 3. Damage caused due to the fire in plant, gain or loss from the early retirement of the debt, and so on and so forth. The next one is discontinued operation. See, the third type of the non-recurring item is basically discontinued operation. This non-recurring item are required to be reported in the FS, that is the financial statement, if the operations of a part of the firm is either being held for sale or has been already been disposed of. So for an item to be qualified as a part of the discontinued operation, two basic conditions should be satisfied. The first condition, that is there is no involvement or influence by the parent company related to the finance or operational matters with the discontinued component, and once the component has been successfully disposed of, so there should not be any influence in this particular case. And the second point is basically the operations and the cash flows from the disposed component will be eliminated from the parent's operation. So operations and cash flows. Now the next one is changes in accounting principle. If you see in this, the fourth non-recurring item is changes in accounting principle. It happens when there is more than one principle available for applying to a particular financial situation. See, remember one thing, that the changes should be backed by the rationale that proves that the relevance over here. So these changes have an impact not only on the current year but also on the financial statement of the prior period, as they have to be applied retrospectively to ensure uniformity. Now, if you talk about retrospective implementation, ensures that there is a proper comparison of the same. And if we talk about the proper comparison can be done between the financial statement of different periods, usually an offsetting amount is adjusted to capture the cumulative effect of such charges. Let me show you some details regarding the same. Now in this particular case, as you can see, there is revenue, COGS, GM, SGA, and other details. Over here, the important things that we have to note is extraordinary loss or net of tax, that is 1. Cumulative effect for the changes in the accounting principle net of tax is 3. So changes in inventory management principle from LIFO to FIFO, or a specific identification method of inventory valuation or vice versa, leads to significant change in the inventory cost. If you see about change in the depreciation method from straight line method to the sum digits of hour of service method, also leads to some significant changes in the way depreciation amount is reported. Now let's learn what problems, I'll just write for you, what are the problems do non-recurring items pose to the investors and the analyst. So we'll say the first one is the investors and the analysts, they perform financial statement analysis to estimate the future earning from current earning. In reality, the profits reported in the statement are really noisy and they get distorted by the inclusion of the gains and losses from the non-operating and non-recurring item. This problem is referred to as issue of earning quality. Okay, many companies are increasing this non-operating, you can say, income, as it helps them to hide the losses which they incur from their normal business operations. So if you see, the immediate job of the analyst to identify is the main source of revenue and expenses, and also to identify the extent to which the company's earning depends on. Company's earning depends on. Now finally, I'm going to show you an example of restated income statement due to discontinued operation. Though the net income remains unchanged, the restated statement allocates the income between the income from the continued operations and the income from the discontinued operations. Let's have a look. This is the correction by analysts to identify, how the actual earnings are being restated. The original ones and the restated one, where there was no mention of the discontinued operations, but it is mentioned in the restated from the discontinued operations. So finally, let's get into the remedies. The remedies for dealing with the non-recurring items. See, reporting standards follow different approaches when it comes to displaying the non-recurring items. See, IFRS, if you go, it ignores the extraordinary items completely, but reports all other types of, whereas, GAAP basically reports all the types of non-recurring item, and these items are well explained in the footnotes of the financial statement. The first one is basically to allocate them within the single financial year. See, this approach basically talks about reporting non-recurring items with the same financial year. Though allocating gains or losses to a single year does not seem to be right way for handling such items, it is still a preferred when dealing with the items that have small amount attached to them, or they have a very little impact on the valuation metrics like EBITDA or net income. The second one is basically use of, you can say, straight line spreading, that is known as distributing them historically. See, this approach basically emphasizes on the principle of the spreading of the non-recurring items over the past accounting periods to estimate the real earning power of the company. The only demerit that it carries that it may misrepresent the economies within the financial period. And the last one is exclude them all together. So though it seems basically in this particular case to be the easiest of the three approaches, it involves a lot of rationalization and logical thinking by the analyst while deciding which item he or she should exclude. There has to be proper justification for the exclusion, and when he or she does this, there has to be proper adjustments in the tax to nullify the gain or loss attached to with them. Like for example, an early retirement of debt can be excluded from the current year. So it is suggested that the small items which have have a very lesser impact on the net income should be accepted within the financial year itself. So I'll just write lesser impact for you. Second one is that, if an item altogether excluded from the proper adjustment, it should be done while reporting in the income tax. And the third one is the items that have been excluded from the single year analysis should be included in the historical statement, which encompasses different accounting periods using the straight line spreading approach. This averages out their effect just like capitalization average out and a newly acquired PP, that is the property, plant, and equipments over its useful life. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.